Welcome back to the Daily Crypto Roundup. Today's market is giving us one of the clearest signals yet that Bitcoin is no longer just being treated as a speculative trade. It is being built into income funds, wrapped into corporate credit structures, used as collateral for new financial products, and still reacting to global central bank policy like a proper macro asset. And the big story today is BlackRock. Before we get into it, this episode is brought to you by Kraken. If you're looking to buy Bitcoin, Ethereum, XRP, Solana, or build your crypto portfolio properly, you can sign up using the Kraken link in the description. We are also giving away 20 XRP to listeners who sign up through the link, so check that out below. Now let's get into the market. Bitcoin is trading around $66,000 today, after bouncing from around $65,600 following the Bank of Japan's latest rate decision. Ethereum is sitting around $1,800. XRP is around $1.23. Solana is trading around $74. BNB is near $606. Hyperliquid is one of the stronger movers, trading around $75 and up sharply on the day. Cardano is weaker, sitting around 17 cents, while Chainlink is around $8.27. So overall, this is not a full risk-on explosion. It is more of a selective market. Bitcoin is holding. Solana is slightly stronger. Hyperliquid is showing momentum. But several major altcoins are still under pressure. The first major story is BlackRock launching a new Bitcoin income fund. BlackRock's new iShares Bitcoin Premium Income ETF, trading under the ticker BETA, is designed to give investors Bitcoin exposure while also generating monthly income through a covered call strategy. The fund holds spot Bitcoin and shares of BlackRock's existing iShares Bitcoin Trust, while selling call options on roughly 25% to 35% of the portfolio to collect option premiums. That matters because this is not just another Bitcoin ETF. This is BlackRock trying to solve one of the biggest objections that traditional investors have always had about Bitcoin. It does not produce cash flow. For years, a lot of income-focused investors have looked at Bitcoin in the same way they look at gold. They might respect it as a store of value. They might understand the scarcity argument. But if it does not pay a dividend, does not pay interest, and does not produce income, they struggle to justify putting serious capital into it. BlackRock is now effectively saying, fine, we can build income around Bitcoin without changing Bitcoin itself. That is a major shift. This fund is not meant to replace iBit. BlackRock has made clear that it sees BETA as a complement to its spot Bitcoin ETF, not a substitute. iBit is still the cleaner product for investors who want direct Bitcoin price exposure. BETA is for investors who are willing to trade away some upside in exchange for monthly income. That is exactly how covered call products work. You own the underlying asset, but you sell call options against part of the position. That gives you option premium income, but if Bitcoin rips higher, part of the upside may be capped. So this product is not perfect for every Bitcoin bull. If you believe Bitcoin is about to double, you probably do not want to cap your upside. But if you are an income investor, a retiree, a fund manager, or someone sitting on a large Bitcoin allocation who wants cash flow, this becomes very interesting. And this is where the market is clearly heading. The first wave was spot Bitcoin ETFs. The second wave is options, income products, credit products, and structured exposure. Bitcoin is being pulled deeper into the financial system, and that leads perfectly into the next story. Michael Saylor rejecting Ethereum-style Bitcoin yield. Saylor said Bitcoin does not need staking, inflation, or protocol-based yield to reward investors. His argument is that Bitcoin should stay pure, scarce, neutral, and unchanged, while financial products built above Bitcoin create yield for different types of investors. That is a very important distinction. Ethereum has staking built into the network. Holders can earn yield by helping secure the protocol. Bitcoin does not work like that. Bitcoin does not pay staking rewards. It does not issue new coins to validators in the same way. And Saylor's view is that this is exactly the point. Bitcoin's strength is that it does not need to change. In Saylor's framework, Bitcoin sits at the base layer as pure digital capital. Above that, you can build digital credit, digital money, digital yield, and digital equity. In simple terms, Bitcoin itself remains the reserve asset, while companies, funds, and capital markets build financial products around it. That is why strategy matters in this conversation. Strategy remains the largest public corporate Bitcoin holder, and the company recently bought another 1,587 Bitcoin for around $100 million, bringing its total holdings to 846,842 Bitcoin. Saylor is not saying Bitcoin holders should magically earn yield from the base protocol. He is saying yield can come from balance sheet structure, credit instruments, preferred shares, and financial engineering built around Bitcoin. Now, some people will love that. Others will be more cautious. Supporters will say this is how Bitcoin becomes the foundation of a new capital market. Critics will say that once you start layering debt, preferred shares, credit products, and yield structures on top of Bitcoin, you introduce risk. Bitcoin may stay pure at the base layer, but the products built around it can still become complex. That is the debate. But the big picture is clear. Both BlackRock and Saylor are pointing in the same direction. Bitcoin is no longer just buy it and hold it. The market is now asking how Bitcoin can create income, collateral, credit, and capital market products. That is a sign of maturity. The second big market story today comes from Japan. The Bank of Japan raised its key interest rate by 25 basis points to 1%, the highest level since 1995. Normally, that kind of news would be negative for risk assets, because higher rates usually mean tighter liquidity. But Bitcoin actually rose after the announcement, moving from around $65,600 to around $66,000. The reason is that markets looked beyond the headline rate hike. Yes, the Bank of Japan raised short-term rates, but it also gave investors a dovish signal by pausing its bond taper and fixing monthly Japanese government bond purchases around 2 trillion yen. That helped calm fears about long-term yields rising too aggressively. In plain English, the Bank of Japan tightened with one hand, but softened the blow with the other. And for Bitcoin, that matters, because Japan has been a key part of global liquidity for decades. Ultra-low Japanese rates help support global markets for years. When Japan tightens policy, people worry about money becoming more expensive globally. But if the Bank of Japan is still trying to control long-term borrowing costs, markets can interpret that as less aggressive than the headline rate hike suggests. That is why Bitcoin bounced. This is also another reminder that Bitcoin is now trading like a global macro asset. It reacts to central banks. It reacts to bond yields. It reacts to liquidity. It reacts to the dollar and the yen. That does not mean Bitcoin has lost its long-term scarcity story. But in the short term, macro still matters. The third story is a wild one from Polymarket. A brand new Polymarket account reportedly turned around $4 million into roughly $9 million in profit after betting against Spain in the World Cup. Spain, one of the tournament favorites and the reigning European champions, was held to a draw by World Cup debutants Cabo Verde. The winning account, called Fish Alive, placed two huge bets. One was that Spain would not win the match outright. The other was that Cabo Verde would stay within 2.5 goals. When the match ended goalless, both markets paid out. According to the report, the wallet redeemed about $4.7 million on the Spain market and $8.5 million on the spread market, giving it a one-day profit of roughly $9 million. That is a ridiculous outcome. But the more important point is what it says about prediction markets. Polymarket is not just being used for elections and crypto bets anymore. It is becoming a serious venue for sports, politics, macro events, and real-world outcomes. And because these trades happen on-chain, people can see the wallets, track the bets, and question whether someone simply got lucky or had better information. That is where the scrutiny comes in. A days-old wallet suddenly putting millions against one of the strongest football teams in the world is always going to raise eyebrows. It does not prove anything improper happened, But it shows how transparent on-chain markets create a different kind of public analysis. Everyone can see the trade. Everyone can question it. Everyone can track the result. On the other side, another trader reportedly lost nearly $1 million backing Spain to win, for a potential profit of only around $85,000. That is the danger of betting heavy favorites. You risk a huge amount for a tiny return, and one shock result wipes you out. For crypto listeners, the lesson is wider than football. The same logic applies across markets. When a trade looks obvious, the reward is often tiny and the hidden risk can be massive. Crowded certainty is dangerous. The fourth story is Robinhood cutting jobs. Robinhood announced plans to lay off about 290 employees, roughly 10% of its full-time workforce, as part of a restructuring push. The company expects around $28 million in related charges, including severance, employee benefits, and share-based compensation costs. On the surface, layoffs sound bearish. But Robinhood framed the move as proactive and said it is trying to reduce management layers, operate more efficiently, and create a leaner business. CEO Vlad Tenev said the company's business had never been stronger. And Robinhood pointed to record June month-to-date average daily volumes in equities, options, and prediction markets. That is interesting because Robinhood had a weaker first quarter, partly because softer crypto trading activity weighed on results. Now the company is saying trading activity has rebounded, but it still wants to restructure while it is in a stronger position. The market seemed to like the news, with Robinhood shares rising nearly 3% in pre-market trading, even though the stock had fallen 13% year-to-date through Monday's close. For crypto, Robinhood still matters because it is one of the easiest entry points for retail investors. When crypto trading heats up, Robinhood benefits. When retail interest fades, it feels the slowdown. So the layoffs are not just a company story. They are part of a wider signal that trading platforms are trying to stay lean while waiting for the next real retail wave. And that brings us back to the overall market. Today's roundup has one clear theme. Crypto is becoming more financialized. BlackRock is turning Bitcoin into an income product. Saylor is explaining how Bitcoin-backed credit and equity structures can create yield without changing Bitcoin's base layer. Japan is reminding us that Bitcoin now reacts to central bank policy. Polymarket is showing how on-chain prediction markets are becoming serious trading venues. And Robinhood is restructuring around a market where crypto, equities, options, and prediction markets are all merging into one trading ecosystem. This is not the same crypto market we had 5 years ago. Back then, the story was mostly speculation, exchanges, altcoin cycles, and retail hype. Now the story is ETFs, income funds, corporate treasuries, public company balance sheets, prediction markets, macro liquidity, and institutional product design. That does not mean risk has disappeared. In fact, some of these new products add new kinds of risk. Covered call Bitcoin funds can cap upside. Bitcoin-backed credit can become fragile if leverage is mismanaged. Prediction markets can create massive losses for people who misunderstand odds. Trading platforms can still suffer when retail activity cools. But it does mean the market is maturing. The key thing to watch now is whether Bitcoin can hold the $65,000 to $67,000 area and build momentum from here. If it does, the next leg could pull more attention back into Solana, XRP, Hyperliquid, and the stronger altcoin names. But if Bitcoin loses this range, the market could quickly go defensive again. For now, this is not a panic market. It is a selective accumulation market. Institutions are still building. BlackRock is still launching products. Saylor is still expanding the Bitcoin capital market story. And despite macro pressure from Japan, Bitcoin is still holding around $66,000. That is the signal. The market might not look explosive today, but underneath the surface, the infrastructure keeps getting bigger. Drop your thoughts in the comments, smash like, follow, and we will see you at the top.